In an inverted market, and that's usually a very aggressive market, and we'll see some charts in a moment how inverted markets and normal markets look different. Cash is down, and so there's a gain there, and then futures are up, and there's a gain there. And so the long hedgers have the opportunity to profit during the convergence of the cash and the futures during an inverted market or a not normal market. So it's very exciting to see what's happening. And it also goes back to what I said before. Understand the contracts you're trading. As you're watching the charts, know why things are happening, and know if the market is going opposite of what it's supposed to be doing, if it's an inverted market or a normal market, and who's being favored in that scenario. And as I said, normal markets, shorts are being favored, inverted markets, longs are being favored. So when you put all of this together and we start looking at the futures, the cash, and then the basis, and we start driving closer towards the end of a contract's term, be it to the last notice days, or as futures and cash converge closer to these last notice days, we see that there are a lot of great near-end contract plays that are quick, fast, you get in and get out, and you just have to watch them and understand what the contracts are doing. It also gives you an opportunity to view what is happening in the supply and demand. You have to realize when a market is normal, that means that either there's not that much demand for it, or there's an oversupply of the goods. Inversely, when the market's inverted, you've got people either demanding a lot of the product or the supply is short. So it's good to get a picture, if not of this contract that you're potentially trading, which is most likely the spot month. It gives you an idea of what the next 2, 3, 4 different expiration months are doing by seeing where the supply and demand effects are happening right now. It also gives you a clear opportunity to take advantage of a contrarian view to investing. When you understand that in normal markets, shorts are strong, and they get stronger and stronger as it gets closer to expiration date, you have an opportunity to see these new highs being made and realize that basically deciding on what time you enter or exit, you have an opportunity to short just on the supply and demand information, that shorts get preferential treatment near the end of contracts. And then vice versa. During an inverted market, when everyone believes it just can't get any lower, then you know that during an inverted market, longs get preferential treatment, and there may be an immediate long end or near end rally. So it's good to understand how futures, cash, basis, convergence, and the last notice days and trading days all operate together. And again, as I said before, there's not that much written on this subject. Most of the time, the hedgers are taught these strategies as marketing strategies for themselves in order to profit. But the speculators ignore this side of it altogether, and I think that's a huge loss. Since I speak to hedgers as well as speculators, it's important for me to kind of give you a little bit of insight into what these guys are thinking and how you can exploit what they're willing to give away, which is the difference between the cash and the basis, for your own profit opportunities. Now we'll start going into what it means to be a normal market and what it means to be an inverted market, and give you examples of exactly what a normal market looks like. And there are special terms in every industry, and one of the terms in our industry is contango for a normal market. And what this simply means is futures prices get progressively higher as maturities get progressively longer, creating negative spreads. So the reason why futures get progressively higher as time goes on is because of a myriad of factors. Primarily, when you're talking about traditional commodities, you're talking about storage fees, you're talking about financing, you're talking about insurance rates, you're talking about employees and silo storage costs, and all the fees associated with warehousing a product for 3 months, 6 months, a year. When you're talking about financial futures, it's a little bit different. Most of the cost comes into play through interest rates in actually how long you would be borrowing the money. So if it's 3 months to hold a euro dollar or 6 months to hold a euro dollar, every month is successively more expensive in a normal market because of the amount of interest that is being paid on the treasury bond or the euro dollar. So let's look at an example of what a contango market or normal market looks like. Now, this is the exact prices taken on January 12th, and I try and do my best to stay up to date and current on what's happening. And one of the ways that I did this here is to try and give you a snapshot of exactly what a normal market would look like. And when you go through the newspaper, this is what you'd be seeing. You'd see the symbol for the contract. This time I picked coffee. And then we see the months. And as we see here, these are each one of the delivery dates for coffee. We have March, we have May, July, September, and then December. So we have a 5-month cycle here. When you look to the right, these are the last, I took the last price of the day on January 12th for each one of these markets. As you look here, successfully each month gets higher. You start off with the month March, which is closest to the cash, which is called the spot month, and that's 68.80. You go to 70.55 in May, July is 72.30, September is 74, and December is 76.70. So all approximately almost $2 difference between each successive price. Only reason why that is because of the insurance, the storage costs, and just general expenses that come with holding these contracts for the length of time that they're held. So the difference between March and December is $8, practically $9, and that's all storage fees and expenses and costs that go into holding a contract for practically 9 months. So when you see the shorts, how you see the shorts profiting from this is solely because of the difference. Eventually, the 68.80 has to, in the spot month, get close to what the cash price is, which may be 68.50 at the time. And as the contract continue to get closer and closer, they start to decrease in price to get closer to whatever the cash market or whatever the supply and demand is for that contract. So these prices are very fluid, solely based on what's happening in the supply and demand market. Next, we'll look at what's a chart of how this all plays out. In the red, we see the furthest out month, in this instance, July. Then we see in the blue the second month. And then in the green, we see the nearest month, or the spot month, which would be the March month. As you can see, all from November all the way till now, this market has been in a normal pattern. Even though the prices have slowly, progressively been going up, every successive month that's further out from the green month, or the March month, has gone up in price as well, solely because of the fact that insurance and the shipping charges are being built in. So this is a typical market in futures, and we'll talk about how to trade against this and where the profits are to be made in seeing how these markets change. In more trading the price, we can look at backwardation. This is what I mentioned before as an inverted market. This is when the cash price or the spot futures price or nearby futures price is greater than the more distant futures price. So it's best to show you as an example. In this instance, we've seen a lot of the news about the crude oil, from Halliburton's shenanigans in Iraq to worries that the Iraqi production will be permanently stilted, and the price of crude oil has just been going through the roof. And here's a prime example of an inverted market. February, the months go from February to June, and we look at February. The price is $34.33. We look at March, the price is $34.06. We look at April, $33.52, May, $32.94, and June, $32.40. This is a classic example of an inverted market in which the demand for oil, or the perceived idea that the supply is weak, is actually keeping the near oil prices up far above the cost associated with storing crude oil in June. February is up $34.33, and in June it's $32.40. That's almost a $2 difference in price. So the storage fees and the insurance fees and the interest fees don't matter, because the need of the public or the hedgers to protect themselves either from huge price fluctuations or to take delivery of this oil is more important.